Hey, good morning, everyone. Marty Missouri here, August 22nd, 2021. For those of you who like digging into the weeds a bit, I'm going to look at three of our core positions from a technical perspective. But I wanted to talk about the events of last week and relate that to the conversation we've been having here for well over a year. So to begin with, here's a 5-day look of the returns for major U.S. sectors, global indices, some commodities, and so on. We do this across this and across all, foreign markets and most major commodities and so forth every single week. And but I snipped this out because I want to talk specifically about some of these areas within the context of last week. So notice how financials just got hammered last week, down 2.3%. Industrials down 2.3%. Materials down over 3%. Discretionary down over 2%. Energy down over 7% last week, right? And then you've got the Dow down 1%, S&P pretty flat, down just 0.59, but the NYSE down over 2%. International developed, that's the Europe, Australasia, and Far East Index, down almost 2.5%. Eurozone pushing 3, Asia Pac over 3, emerging markets almost 4% decline and a big decline, particularly in Latin America. Bonds rose 1.35, they rallied. Gold rallied just a smidge. Silver got hammered, copper got hammered, groceries got hammered, right? So, folks, recall my preaching again for the better part of the last year that going forward, to be successful, we're going to need to get the currency right? We're going to need to get the dollar right. And we're going to really need to get the inflation narrative right. Okay, so again, this will be very familiar to you faithful video watchers, right? Because I said if this dollar busts out to the upside, stocks, commodities, you name it, they're going to go through hell to the downside, right? And sure enough, we did break through this pretty good resistance that we've been seeing, since the spring in the dollar last week, right? And we've got a buy signal here, short-term buy signal on the MACD. Going to getting close to overbought here on the RSI. But even though you saw the S&P kind of hang in there, and by the way, let me bring that back. So tech, right? Tech held up. Tech was up almost 0.5%. And of course, look at your, your staples, right? Your defensive sectors, and I mentioned the bonds and gold. Well, tech is your longest duration. Without getting into the weeds, just suffice that to say, your most interest rate sensitive of the sectors. So you think about utilities in that regard, and you can see utilities did fine, but tech really is going to be crazy interest rate sensitive going forward. Also, what was the big fear last week? There were several things, but Delta variant, right? So Delta variant takes hold again and we have big global lockdowns. Well, of course, things like, your cyclical sectors are going to take a hit as they did last week. And, as people stay home and do their techie thing, well, then tech looks good, right? Well, it's very pricey, historically speaking, by just about every valuation metric. It occupies 27% of the S&P 500, the cap-weighted index. And that explains why the S&P continues to hold up okay. The last time it had that kind of concentration, the S&P, was right before the tech bubble burst in the early 2000s. Since that point, the last time we had any sector that had that kind of concentration in the S&P was financials right before the great financial collapse, right, in 2008. So we need to be very cognizant of this over-concentration and recognize that if we get a big risk-off event and people sell all that exposure to the S&P, well, where are you going to feel it, right? You're going to feel it right here in the tech sector. So we are very guarded. It's only 5% of our target allocation. Gold held up okay, which is not a small position. But it was a rough week for those global macro portfolios that I'd like to say are doing the work and see what the long-term prospects and probabilities look like. Short-term, though, who knows? Like I said, I think last week on a video, I feel real good about our allocation for the next 5 years. Next 5 days, 5 weeks, 5 months, I don't know. There's just a lot to shake out still. And of course, this Delta variant throws a real wrench in the narrative, of course, near term. Okay, so again, back to the dollar. You have the look of a rising wedge pattern, right? And you have a higher high but you have a lower high on the momentum indicators. But I continue to tell you folks, if the powers that be can control these things, this dollar is not going to be allowed to go shooting through the roof. So you saw again how ugly the week was for emerging markets, and they're going to be exceedingly sensitive to the dollar. This is a 2-year daily chart for our position, the Vanguard Emerging Market Index. It broke down, fell out a bit, but 200-day moving average, found resistance there. You've got a rolling over 50. You still have an upward sloping 200. This right here, if the 50 crosses below the 200, it's called a death cross, technically speaking. Right now, we have a lower low, but we have a relatively flat look on the MACD. We have a higher low on the RSI, and we're oversold below that green line. I'm not counting on anything short term, and you can see that if it does break down, we got a pretty good move before we find anything meaningful in terms of support, and that would be another 10% or so below where we are currently on the price there. We did add a little bit of hedging here this last week, just to give you the detail so you see those confirmations. We were hedging our energy exposure. Our biggest exposure is XLE, the energy ETF, but also OIH, which is energy services companies. That one took the bigger hit. So we actually we hedged those back when I got concerned about oil prices. They immediately fell. I told you this before. Nick had the wisdom to recommend that we roll those hedges and basically recoup our cost basis, and because we had big profits on those, and just move them down a little bit further away from the price, but giving us meaningful downside protection in a big sell-off, which is really all we were after. And so we did that. So now we were just hedging with profits. Then on the oil services ETF, those grew by 300%. Now, again, we're not talking big dollars because it didn't cost much to hedge that. It wasn't a big position. So we went ahead at these levels and pulled off that hedge. And we were able to use that money, actually a little less than that, and hedge our emerging markets position with a put option just 10% below the current price. So these things can get really volatile, particularly in this world. Imagine if suddenly we did have a big global lockdown because of the Delta variant. The dollar's probably going to ramp up in that scenario, and then you're going to have emerging markets take a bigger hit. So we did go in with a really cheap put option. I guess you could call it free because we're just dealing with profits from a previous hedge. So that risk is there. Now, folks, none of you who are clients who are watching this are invested with us for just 2021. In fact, people who would come to us at the beginning of the year and say, hey, I've got some money with, I only have a 1-year time horizon. What would you do with it? I'd say, well, keep it in the bank, right? Don't ever invest with a 1-year time horizon. If we're talking 5 years, then we have something to talk about. But no, don't invest in any market short term. So I don't know how 2021 is going to shake out. Again, I feel very good about our allocation long term. And prior to the Delta variant, quite frankly, my optimism was growing for the second half of the year. So we'll see how that plays out. But the question is, if you're a short-term trader, well, then you might abandon some of these trades. You move out of some of the commodities situations. You pay all the taxes on your capital gains, and you try to play the short term. If you're a long-term investor and the thesis still holds, and there's nothing that's gotten in the way, in fact, to some degree, maybe it's strengthened. Well, if you know how to hedge, you hedge some of those positions so nothing devastating can happen. And you be prepared to buy more. Recall that last week I said, I think in 1 or 2 of the blog posts, that we're looking to allocate more of our cash, our short-term bond position, which isn't small, into our best ideas. But we were thinking that we might see some pain in August and September, and we'll have some lower prices to take advantage of come early fourth quarter. But I said last week, if this keeps up, we might want to exploit an opportunity sooner than later. Not doing it today, but we are keeping our eye on it. So while you've noticed it, if you're watching your stuff every day, you've noticed what's happened this last week in particular. We're not thinking about our portfolios in a 1-week context. We're thinking about them within the context of where we see probabilities over the long term recognizing that we're going to get this chop in here. And then quickly, the S&P 500 chart we looked at the other day. Recall that I said that this 50-day moving average will probably be good support. We were up in here when we ran that video. Sure enough, came down, touched it last week, bounced right off of it. This one isn't looking so healthy to us. So this is that volume indicator. We are below the line right here. And we indeed, now we did break out a little bit out of that bottom there, but we have kind of your classic, really, do it this way, kind of your classic rising wedge here. And yes, we do have those divergences, most definitely here in the MACD and here in the RSI. So the U.S. market looks suspect, but until we break down below, say this trend line, I can move that here, right? And below that 50-day moving average, you really don't have a sell signal. Nothing really actionable with this. If I were short-term trading this, the S&P, I'd look for something with some momentum, and then I expect to make some money on the downside. We did that technical analysis on the S&P. Remember, we did it on gold too, and I said this was getting interesting, and I had this shaded buy zone in here. And I think we were right here when we had that conversation. Sure enough, we bounced right off of that back into here, and we're kind of struggling with the 50-day moving average, which is kind of settling down in here. So gold, and you have kind of a nascent buy signal below this line here. That's a little extra oomph. You're not remotely overbought in here, so gold looks okay. I will say this though, gold, you would think with the dollar rising last week, you'd think from a textbook perspective that gold would have tanked along with other commodities. Well, gold is trading not so much on the dollar these days, it's trading more on real interest rates, and that's nominal interest rates minus the inflation rate. Right? So interest rates plunged last week when everybody thought, either the Fed's going to kill the expansion by tapering its quantitative easing and or the Delta variant, right? Well, gold doesn't pay a yield. Therefore, when yields are dropping, it doesn't have much competition out there. And, historically, it's been your ultimate safe haven, right? So in a world that comports with our long-term thesis where inflation is going to go up, but because of the debt bubbles, because of all of the trillions of dollars of dollar-denominated debt on emerging market and other foreign corporation balance sheets, and we're not going to be able to get into those weeds too much today in the interest of time, but that's something that we've talked a little bit before, probably warrants its own presentation. Suffice to say that rising interest rates and a rising dollar on a global basis, not only the huge risk when you look at the debt bubble here just in the US, just really cannot happen and keep asset markets and keep economies buoyant right here. And the powers that be, that's what they exist to do, is try to keep things buoyant. So gold looks uniquely positioned for the next few years. The next few days, weeks, and months, I don't know. It's actually been kind of a ball and chain, as I said the other day on our portfolio right here, even though it was great here and there. But it's not a position to be abandoned. We do have it pretty well hedged, so it can't be devastating for us in the long run. But sure, I mean, relative performance-wise, it hasn't been a good thing to own lately. It'll be a great thing to own if we're right on our narrative. And it's not a bad thing in a portfolio that wants to have some semblance of balance and some semblance of negative correlation where things aren't always moving together at the same time. Our Ag Futures Fund, DBA, been a great position for us. You can see you've got a real toppy look right in here. Just can't seem to break above that resistance level there. You break down below that 50-day moving average from a technical perspective, things could get ugly in here, right? We do have the beginning of a sell signal here on the MACD and rolling over here on the RSI. Now, if you look at these two tops right here, you hang in there okay. So you don't have a real divergent situation here on these, but longer term you do, right? You do have these tops, and you do have a breakdown here. So the technical look right now for our ag commodities position is suspect. Now we do have that hedged a bit. So if it really fell out of bed, we do have some protection in there, so it's not too devastating. We'll probably keep that on there for a while. Other than that, though, you have an upward sloping 200-day moving average. You still have an upward sloping 50-day moving average. So you still are clearly in an uptrend. And we could break down, easily right into here and still be in that uptrend. We break through there, though, and technically speaking, we could see some selling. So dollar sensitive for sure. Weather sensitive for sure. So look for lots of volatility here, folks. But if you just think about what we're looking at in terms of feeding the world and the challenges there around COVID and bottlenecks, and then this really crazy weather that we're seeing all over the world, what that does to price. I suspect we're going to want to have a position directly in ag commodities for quite some time going forward. At least that's our thoughts as we sit here today, all things considered. And then this is getting to be a familiar narrative for you folks. S&P 500. Actually, I should do this. All the way back to the beginning of the last bull market. S&P 500, right? Emerging markets, Asia Pacific, gold, Eurozone, and agricultural commodities, okay? Look at the incredible divergence. Remarkable. Just think about how investments and prices tend to revert to the mean. There is just potentially huge downside here for U.S. stocks to catch down. Huge upside here for these areas. Now, what if they meet somewhere in the middle, right? So you've got this potential, you have that potential, or you have, this potential, right? In two of those three scenarios, these things go up, right? In two of these three scenarios, the U.S. market, using the S&P as our proxy, goes down. What we're doing is we're just emphasizing where we think there's value, and we do have, frankly, a little less than half of our equity exposure right smack dab in the U.S. It's just in things like industrials, materials, and healthcare and staples and those things as well. And just less of the growthy stuff that's been making this happen. I really think right now, from a longer term perspective, this is far and away the smartest way to approach the asset markets going forward. It's just in the short term. I'll say it once again, 5 days, 5 weeks, 5 months, who knows? 5 years, odds favor what we're doing right here. I can say that with a great deal of confidence. And then lastly, I want to point you to an article in Bloomberg, ironically this morning. Goldman Sachs and B of A see the lost decade over for emerging markets. Elevated commodity prices and expectations for earnings growth are igniting bullish bets on emerging market equities. And again, that's one of our biggest positions. After more than a decade of underperformance that left them approaching a 20-year low against developed nation stocks. So, ironically, this is pretty much our narrative, and now Goldman and B of A agrees with it, and we're already there. So if we get, a ton of money rotating into emerging markets, which is what I suspect is going to happen, well, that's going to bode very well for the performance of our core allocation. Basically, tell the story we've been telling. Investors will capitalize on cheap valuations once vaccine roll-ups pick up, helping the global economy to recover from the pandemic. And so it goes on and on, but it's just a very familiar story because it's what we've been telling you here. So that also speaks to relative performance in a lot of other areas that we're in as well. Asia Pacific, Europe is a unique story in and of itself. I presented that via actually another analyst yesterday in our macro update. So folks, I will leave it there. Thank you as always for watching and listening. Talk to you again soon. Bye-bye.